On Friday, the U.S. stock market shed close to $1 trillion in a single session. There was no war, there was no surprise from the Federal Reserve. The trigger was one chip company's sales forecast. Broadcom told investors its next quarter of AI chip sales would come in around $16 billion. Analysts had expected $17.2 billion. It declined to raise its forecast for the year. That was the entire event. The Nasdaq fell 4.2%, its worst day since April of last year. Marvell dropped about 16%, Micron 13%, Intel and AMD near 11%. One forecast, slightly short, and the selling ran through the whole sector. Nothing actually broke. A handful of AI names carry the entire index now, and the moment one of them blinked, there was very little underneath to catch the fall. The 10 largest companies in the S&P 500 make up close to 40% of it. Last year, that figure reached 40.7%, the highest on record. The index sitting inside most retirement accounts is no longer a bet on 500 companies. It is a bet on about 10. And those 10 are increasingly the same trade, the same AI story, the same customers, the same suppliers. On the way up, the gains look effortless. On the way down, the diversification you thought you owned is not there. Friday wasn't about Broadcom. It showed how much of the market now rides on a few names. One of them had a quiet quarter, and that was enough.